Welcome to Mayor Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayor Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners. Our topic today is what to expect in banking regulation in 2024. My name is Matt Bisanz, and I'm a partner in Mayor Brown's financial services practice in Washington, D.C. Joining me today is my fellow partner, Jeff Taft. Jeff is also a partner in our financial services group. With that said, we have a number of topics that we'd like to talk about in the 2024 banking regulation climate, and we don't make any promises that these will come to pass, but from our experience, these are the ones that most people are talking about and have been most interested so far. Jeff, could you get us started?
Thank you, Matt. Let me start by stating the obvious with respect to commercial real estate and commercial lending. The regulators are focused on this, and they're focused on loan performance throughout the economic cycle. I think we're seeing the guidance and the focus coming in two particular areas right now. We're seeing it, one, around workouts and accommodations, and then secondly, we're seeing it around risk management and concentration limits. The regulators have revised the guidance on prudential CRE loan accommodations and workouts. This builds on their prior guidance calling for banks to work prudently and constructively with creditworthy borrowers during times of distress. Obviously, some of that distress is being caused by what's happening with interest rates. To the extent that interest rates come down, that may obviously have an impact on the number of loans that need to be worked out or the number of accommodations that need to be met. There's also some existing guidance and some updates to that guidance on CRE loan workouts. The focus has often been on CRE with the regulators because that's been an area where there's been higher vacancies and in office buildings and the like coming out of COVID. There's also new information on short-term loan accommodations. Again, some of those are just trying to bridge people around the interest rate adjustments. So that's something that's kind of continuing to go on. And there's also some changes to the relevant accounting guidance on estimating loan losses. Finally, the guidance also, the CRE loan accommodation guidance provides some updates on how to classify and account for loans modified or affected by loan accommodations or loan workout activity. It's not all just about commercial real estate, though. And when you look at some of the guidance that's come out from the OCC, for example, in November about venture lending, they've really emphasized some of the heightened risks associated with venture capital and venture funding. This indicates that banks should set concentration limits based upon the size and complexity of the credit extensions and the organization. Defines what the expectations are for lending practices and controls, and it requires banks to pay attention to risk rating and repayment sources. Repayment sources is something that the OCC guidance really focuses on, focusing on what is the source of repayment from the venture borrower. Is it simply that they've raised money in several rounds and they're going to continue to raise money and that money will be used to repay lenders? Obviously, the OCC is a little skeptical around that as a viable repayment option. They're looking for earnings and other things on a regular basis, recurring basis that can be used to repay the loan. And that would be the criteria they would expect you to use to kind of underwrite those types of loans. I mean, the focus on commercial real estate, though, is also, I think, something that's occurring both at the federal level, at the national level, but it's also something that's occurring at the state level. So state regulators are also looking at it. I think from the perspective of the types of banks, I think it really impacts all banks, although some of the smaller banks tend to have a higher concentration in CRE loans given their local footprint and some of the things they're doing in their local markets. The FDIC has recently issued guidance or reissued their guidance on credit risk management for CRE loans. It reemphasizes the importance of strong capital and credit loss allowance levels. Also establishes some expectations for credit risk management practices at banks with CRE concentrations and acquisition and development and construction lending. Focus across the regulators is also on concentration risk management. This may reflect the fact that there are concerns with unrealized losses in CRE loan portfolios, which can deter asset sales, securitizations, and other techniques that are historically used to manage the risks associated with those assets while on the bank's balance sheet. Also, I'd call attention to the fact that the regulators have recently proposed some changes to the call reports that would basically require banks to disaggregate and publicly report loans in certain areas of heightened risk. Those areas of heightened risk include private credit, loans to PE funds, loans to mortgage shops, and others. And this may increase the pressure in the review of loan concentrations by the regulators. It's not necessarily totally clear why they're asking for this information, why they want this more disaggregated breakdown of lending activity. But clearly, once the regulators have this information, they're going to use this, and they're going to basically look at the concentrations in these areas. And it's something that I think some banks may be surprised about when they have the regulators come and asking about these types of concentrations. Back to you, Matt.
Thanks, Jeff. That was a really interesting topic, and unfortunately mine will be something people probably have not heard as much about, but maybe even at this point sick of hearing about. That is the U.S. Basel Endgame proposal for the capital requirements. This is the 1,000-page plus behemoth that dropped last July. The comment period was extended through January 16th. We submitted some comment letters for clients. Many comment letters were submitted from the industry, and I think the general reaction was critical of the proposal. People identified a number of shortcomings, both with the U.S. add-ons to the global standards, as well as the way some of the global standards were tailored for the intricacies of the U.S. economy. Overall, the comments are expected to lead to, I think, revisions in the proposal. But more importantly, there are more comment periods coming in 2024. That just last week, the regulators requested comments on the reporting forms that will be used with the capital proposal, somewhat surprisingly, because the proposal hasn't even been finalized yet. Also, the regulators have promised that the information collection they began in September 2023 will be put out for comment so that the industry can express its views on how the impact of Basel Endgame will or should be taken into account in a final rulemaking. All of that's a long way to say that I think we may see a final rule much later this year, sometime maybe in late summer. But as you'll talk about maybe later, we're running into the election year. So this could even, I think, be pushed off until 2025 if we hit some unlucky scheduling currents, or lucky as the case may be. This also would most likely push off the implementation date from the middle of 2025 to, I think, more realistically, the end of 2025 or even in 2026. There also has been talk of, once a final rule is issued on capital, that there very well could be legal challenges to it. That is assuming it passes, that there have been at least some fairly well-messaged dissents from agency principals. And those would likely, as we've seen with other regulators like the SEC, form the basis of any litigation of, if these agency principals have identified such significant shortcomings in the rulemaking, well, the court should at least give those fair consideration. So I think that's another part of the Basel Endgame saga that will continue for the foreseeable future. Maybe for something a little more hip and interesting, Jeff, could you talk a little about digital assets?
Happy to do so, Matt. I think every year we have digital assets and digital asset activity on our what to expect agenda. And this has become kind of a recurring theme, is that not too much has happened. And really, when you look at what has happened, it's been very cautious approach by the regulators. And really, I don't think we're much further along than we were talking about this maybe 2 years ago. I think there's some additional guidance by the regulators. And I think a lot of the expectations that the regulators would kind of, quote unquote, loosen up about these types of activities has kind of gone by the wayside. Bank regulators continue to hesitate on bank involvement with digital assets. There's a perception, at least, that digital assets remain a disfavored activity or presumptively suspect, and I think that continues to this day. We've seen the Fed issue some guidance over the last year that's also, I think, made it a little bit more difficult to engage in those activities and also increase the supervision of those activities. In August of 2023, you had the Fed's SR 23-7, which defines 4 categories of novel activities subject to enhanced scrutiny. 3 of those relate to digital assets. One of those is crypto asset related activities. Another is concentrated provision of banking services to crypto asset related entities and fintechs. Another is digital ledger technology, which is becoming a more increasingly popular area for banks to seek involvement in. And there's also the technology-driven partnerships with non-banks to provide banking services. That could be BaaS, it could be other types of programs that banks are offering. But all of these activities are going to be subject to a heightened degree of scrutiny by the Fed. And the Fed's going to basically be examining those types of novel activities much more carefully than they have been in the past. Also, I mean, we had in January, the Fed had issued a policy statement for state member banks emphasizing digital asset activities, change in the general character of the bank, approval requirements, in Reg H for banks. Banks that have offered digital products or assets or service digital asset providers have stopped or cut back entirely. As I said, there's been a lot of interest by the regulators in crypto-related liquidity risks. I mentioned Silvergate and I mentioned Signature Bank and how they had a number of crypto-related deposits, and they had a heavy runoff in those deposits. And I think that's something obviously that the banking regulators had flagged as a concern, and they started looking at that issue a lot more closely. Obviously, Silvergate is in voluntary liquidation now, as I mentioned, and Signature Bank obviously had failed in March. So those have been resolved, but I think it's a continuing issue with the regulators. Also, the process for obtaining approval to engage in digital assets remains slow. It's not expected, I don't think, to accelerate anytime in 2024. The Fed's policy statements in January of 2023 for state member banks, as I highlighted, increased the focus on changing character of the bank approval requirements, and that's also having a little bit of an impact. Several banks that have offered digital asset products or service digital asset providers have cut back or exited the market. We've even seen some conditions in approvals, for example, where they have to cut back on certain digital activities in order to get their merger or their other activities approved by the regulators. So it's really becoming a more pervasive issue in some of the cases. I mean, only the largest banks seem to have had the capacity to satisfy the regulator expectations with respect to policies and procedures to manage the risk around these assets. And then that's been primarily what I would say in the institution or commercial space rather than in the retail space. I just don't think you've seen a lot of bank activities related to digital assets and consumers or individual activities at this point. Let me kick it back to you, Matt, to discuss the new liquidity proposals.
Yes, certainly. For my birthday last year, I got the present of all those bank failures that put a crimp in some of my celebrations, as many other people had. Those have led to significant concerns from the regulators around bank liquidity, namely that none of the banks that failed were undercapitalized or in most cases even had management concerns, but it was that they hit a liquidity crisis that really no bank could overcome. And the regulators have been considering a number of fixes or attempted fixes for it, but they all run into the insurmountable wall that banking is a liquidity transformation process, that you have banks that have long duration assets on their books and deposits that can be run at any moment. So trying to overcome that basic fact, the regulators are considering several liquidity changes. The most recent is put forward by the comptroller of the currency in a speech earlier this month, where he suggests there should be a short-term 5-day liquidity requirement that would look at the amount of deposits that could be drawn down in an emergency situation over, say, 5 days, and then require the bank to have reserves and pre-pledged collateral at the discount window to satisfy that 5-day period. That, as you may recall, one of the issues with one of the banks that failed was that it had collateral, but that collateral was stuck at a custody bank. That collateral was stuck as a pledge to a Federal Home Loan Bank, and so it couldn't get that collateral over to the Federal Reserve Bank fast enough to get a discount window advance to avoid failure. That would be a new short-term requirement, very short-term liquidity. More broadly, the regulators are considering how to adjust the liquidity coverage ratio requirement, which to date has been the short-term liquidity requirement. That's the 30-day liquidity requirement for larger banks. Some of the things I think that you could see it expanded to a more a broader set of banks, smaller banks down to maybe the 100 billion or even smaller threshold. But substantively, you will see some changes in the deposit runoff assumptions that right now insured retail deposits are assumed to be sticky with a very low, slow runoff rate of, in some cases, as low as 3%, but generally in the 10 to 20% range. Those will likely be ratcheted up, reflecting the fact that one of the banks that failed had as much as a 25% run rate within that 5-day period. So retail deposits are not as sticky as they were once thought to be. There will also likely be some changes in assumptions around operational deposits versus non-operational deposits and other types of sticky deposits that may or may not receive regulatory preference. On the high quality liquid asset side of the equation, the regulators are struggling because they want to force banks to have higher quality liquid assets to reclassify some of the problematic assets where you may have again, government treasuries, very highly liquid asset, unless it has a mark-to-market loss on it. And if that loss is maybe an unrealized loss in available for sale securities or in held to maturity securities, that highly liquid asset is much less liquid. And so the regulators are looking at how they could redefine or reclassify the high quality liquid assets to better serve as a source of liquidity, possibly be pledgeable to the discount window, but also reflect the fact that they can have these mark-to-market losses. That the fear here is if you rely too heavily on the discount window as a way to pledge these assets that have mark-to-market losses, that will become a different supervisory problem if the institution then encounters earnings pressure from the interest rate mismatch and loses the ability to pledge to the discount window. That happened with one of the banks that failed yesterday. So the discount window is not a panacea for these types of assets that have price dislocations, but it is something I think the regulators will try to lean on more heavily, possibly even through a requirement that institutions must test their ability to pledge at the discount window every year. For something that is less episodic than liquidity, we're going to turn now to bank M&A. Jeff?
Thank you, Matt. I tend to think of this more as antitrust policy than bank M&A. But again, I think the two of them obviously go very close together, hand in hand. What we've seen over the last year or so is that there's been a lot of interagency review of the bank merger analytical frameworks. That's been done by the prudential regulators, obviously the banking regulators, but also been working with the DOJ on the competition prong of the Bank Merger Act. Historically, the number of banks and the lack of overlapping markets has really limited the impact of the competition analysis on bank mergers, and it hasn't really proven to be a significant hurdle. I think, depending upon the outcome of these reviews and the discussions, bank mergers and the approval of bank mergers could change significantly over the coming years, and that could have a significant impact, obviously, on the banking market. There's been a number of consolidations over the course of the last 10, 20 years. We've gone from basically having 12,000 banks to down to under 5,000 banks. And I think that trend's going to continue as kind of the regulatory burden is imposed on more and more institutions. I guess the opening salvo this year is really the OCC announcing its action to improve its Bank Merger Act applications process. In the case, they're trying to increase transparency and do some other things. These changes were announced by Acting Comptroller Michael Hsu during a presentation at the University of Michigan School of Business. The OCC is also releasing a notice of proposed rulemaking, which will eliminate the automatic approval after 15 days after the comment period is ended. On a go-forward basis, the OCC will have to basically approve everything rather than things becoming automatically approved by the expiring of time. The NPR also clarifies the OCC's process for extending public comment or holding public hearings on mergers that are pending. The OCC is going to look beyond retail deposits as a proxy for market power, so that's a little different change. I think transparency is also a key point, as the agencies have had a number of pending transactions on the merger front, which have kind of sat in limbo for extended periods of time. Now, some of those are pending resolution of internal regulatory issues that are existing between the institutions who are trying to merge up. But they've just kind of sat out there for a long period of time. And I think even the participants in some of those transactions have been kind of flummoxed by the long period of time that's happened. I mean, ultimately, we don't know what the future standards will be or what they'll entail, but I think it's reasonable to assume at this point that there's going to be a tougher approach taken by bank regulators to approving mergers. And those are going to apply pretty much across the board. So it won't just be the large mergers. I think they'll also be looking at some of the smaller in-market concentrations and some of the in-market merger acquisitions and stuff. So with that, let me turn it back to you, Matt.
Thank you, Jeff. One of the other capital, it's not even a capital, but one of the proposals that last year was highly correlated with the capital proposal was the long-term debt proposal. This was the idea that all 40 of the largest US banks should have some loss-absorbing capacity of eligible long-term debt. Right now, this is mainly the domain of the US GSIBs and the intermediate holding companies of global GSIBs. And the proposal would extend the requirement to all 40 banks and also to their bank subsidiaries, so their insured depository institutions. And the concept here is to give the FDIC greater optionality in resolving these institutions, because it could seek to intervene either at the level of the bank or the holding company and use the eligible long-term debt to resolve and release or sell those entities. This would be an expensive proposition. Many have estimated at least $70 billion in new long-term debt would need to be issued. It could greatly complicate the capital structures of these banks, because many would need to downstream new debt to their bank subsidiaries, but they may not have the cash to do so. However, unlike the capital proposal, the long-term debt proposal is more likely to be adopted in 2024 and less likely to lead to litigation. The economic impact, the scope, the complexity, while it's expensive, it doesn't seem like the kind of thing that will necessarily lead to litigation. There probably will be some changes in the final rule related maybe to the minimum denominations of the new eligible long-term debt, which are highly problematic to market standards, maybe to the bank subsidiary, that again is a complexity that many are facing. So that may change, but this one is much more likely to be finalized before the end of the year, again, with a fairly brief implementation period. But this is one albatross that probably will come to pass on the bank's necks. One thing that could obviously delay it is the election year effect. And Jeff, do you have some thoughts or musings on the election?
Yeah, well, I'm not going to offer any predictions on the election, the outcome, or anything of that nature, but I will talk about two, potential implications of this being an election year. I think the first is that it's going to put some pressure on the agencies to finalize rules as early as possible this year. And obviously, the banking agencies, in particular the SEC as well, have a number of proposals out there that have not yet been finalized. There's an obviously incentive to finalize these rules as soon as possible, such that a new administration, if the election were to go a different way, could have an impact on the ability of these rules to be implemented, or they could be potentially reversed or voided under the Congressional Review Act. So I think you'll see the agencies moving very quickly this year to get done the rules that they need to get done to avoid that potential outcome. The second thing to think about is obviously if there is a change at the White House level from the Democrats to the Republicans, that could have significant impact for the leadership at the agencies. And given that there's been very little going on within Congress, the agencies have had a real kind of leadership role in implementing the administration's policies. So obviously a change at the agencies would obviously have a significant impact on not only what's going on a go-forward basis, but also some of the rules that are kind of left to be implemented. As you saw the last time, there are a number of the rules that were put in place by the Trump administration were never implemented by the Biden administration. So that's something else to kind of keep in mind when you're thinking about the election. So Let me turn it back to Matt. You talk about the Corporate Transparency Act, which seems to be getting a lot of interest now that it's effective from people.
Yes, so I've been spending all of my days now studying the Corporate Transparency Act, which surprisingly has affected mostly our non-banking clients because our bank clients are to a large extent accepted from it, or they've been dealing with this for years under things like the CDD rule. But this will begin to affect banks as FinCEN finalizes two pieces. That FinCEN currently is implementing the method for banks to access CTA filings made by corporates, so the clients of banks, that will have a procedure now so that the banks can request it as part of their CDD compliance, their customer due diligence, their AML and OFAC screening. And again, initially only banks, broker-dealers, futures commission merchants, introducing brokers, and mutual funds will be able to ask their customers for permission to obtain these CTA reports from FinCEN. But eventually, any financial institution with a customer due diligence obligation, including a sanctions obligation, which really opens the door, will be able to request that their customers give them consent to get this information from FinCEN. I think initially it will be slow going. FinCEN systems are not the model of efficiency. And also some of the use restrictions, information security requirements that banks would have to comply with, and also other confidentiality terms will discourage banks from actually pulling that information from FinCEN. Additionally, there's only so much value to that information because the CTA rules, the rules used by corporates to report this information to FinCEN, are different from the CDD rule that banks use to perform their due diligence on customers. FinCEN is required to implement a rule within the foreseeable future to align the CDD rule with the CTA rule. It is said we can expect a proposal in the first quarter of this year, and I think it has to be finalized by the end of this year, maybe next year. I am not confident that it will follow the congressional intent of eliminating everything but a requirement that you know your customer and leaving it up to banks to design that. I just can't see FinCEN giving that much leeway to banks. I suspect it will be something far more convoluted and burdensome to banks. But I guess we'll have to wait to see what that rulemaking proposal has to it. Jeff, I think we got the last one for you here, and then maybe one more for me.
Yeah, thanks, Matt. I just want to quickly hit on the FHLB and kind of the potential reform that's coming down the pipe on that. Obviously, the FHFA recently completed a review of the federal home loan bank system and proposed a series of legislative and regulatory reforms. Some of these are looking at the mission activities by the federal home loan banks themselves, and others could look at the federal home loan bank membership requirements for members. It's an interesting area, and I think for a lot of folks on this call who are members of the federal home loan banks, it could obviously have some impact on members. It could have some impact on the borrowing activities that you typically engage in with the federal home loan banks. I think there's a concern which arose partly out of the bank failures last March, that some folks were relying on the federal home loan banks to serve as lenders of last resort. I think the FHFA would try to move away from that. I think they're also looking, obviously, to increase maybe the affordable housing requirements for some of the federal home loan banks, and maybe increase some of the mortgage lending activities for some of the FHLB members. I think those are just some of the areas that they're looking at. I think this will be an area that will really play out over the next year or so. But it's interesting, again, because I think it impacts a lot of folks on this call who are members of the federal home loan banks and rely on them for sources of liquidity. And as Matt said earlier, I mean, liquidity is becoming a bigger issue for the regulators. So any source of liquidity that is tamped down or dampened could have an impact on the banking industry. So let me turn it back to Matt, who's going to wrap it up with some corporate governance.
Thanks, Jeff. And corporate governance isn't something we usually talk about in federal banking regulation because it's the domain of the states. But as many federal regulators have the propensity to do, the FDIC is veering into that field by proposing last year new corporate governance and risk governance guidelines for what it deems to be larger banking organizations. And if it was to limit itself to the OCC or Federal Reserve's definition, it would probably only be 5 or 6 entities who would be picked up. But the FDIC has proposed to define larger banking organizations as those with 10 billion or more. So it's picking up about 60 FDIC regulated banks. The guidelines would start with the OCC's heightened expectations for banks with things like a risk governance framework, risk appetite statement, but make them progressively more burdensome or stricter with respect to timing, the level of detail that banks must apply. Additionally, the FDIC continues to merge the concepts of board oversight and management and operational management. So again, putting more burden on the bank boards to be involved in everyday business decisions. And just generally some principles that are askew with corporate governance as understood in Delaware and at other state level organizations. We worked on the comment letter for the Society of Corporate Governance, which has some really good points about concerns with it. I think there is a chance that the FDIC will take some of those points into consideration, certainly some of the ones where it would conflict with state law, although I'm not particularly optimistic that it will do things like raise the threshold from $10 billion or otherwise make the guidance in alignment with the OCC's approach. But that probably will come out later this year. I would expect it to be a summer project or possibly a Q3 project because it's low profile enough to not be affected by the election cycle. With that, I want to thank Jeff for joining me today and our audience for listening to us. Really, we wouldn't do this if you weren't listening, and we do hope if you have questions that you follow up with us. Those questions on today's podcast or anything else related to the Global Financial Markets Initiative can be sent to us at gfm@mayorbrown.com. Again, that's gfm@mayorbrown.com. You may sign off now.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayor Brown audio programming, visit mayorbrown.com/podcasts. Thanks for listening.